Let's welcome the Chief Economic Advisor of State Bank of India with a warm round of applause, Dr. Soumya Kanti Ghosh.
Very warm good morning to all of you. It's really a great privilege to have been given this opportunity to address this distinguished gathering today, and in the third edition of the Outlook Money Conclave, which is the flagship event of the Outlook Money. As I think our former speaker has nicely summed up the theme of the conference, and I'll also borrow a little bit from there in the course of my discussion today. The buzz has been created about aspiration to become a 5 trillion economy. The theme of basically moving towards a 5 trillion economy is basically a very fitting theme. As Mr. Vijay said, India is now the 6th largest economy in the world. India remains a promising story of growth at scale. And as he said, it is taking continuously shorter spans to add each subsequent trillion of dollars to GDP. First was 55 years, second I think came in around 7 years, and the last one came in the last 5 years. In fact, China has doubled its GDP in 4 years and quadrupled it in 8 years. So we have examples before that to emulate. That's a separate thing. However, the recent entrenched slowdown has put a serious question mark of such an aspiration. In fact, if you look into the current global and domestic economic scenario, not to speak of the recent virus in China, which is actually has put a lot of uncertainties in the global economic scenario, we are actually dealing with a lot of uncertainties, and economic policy making is grappling with a lot of apprehensions about the future. So what is required today is that you reconsideration of the basic principles to design an effective and flexible regulatory mechanism capable of dealing with the structural changes which we have unleashed, the financial innovations, and of course systemic risk. So what I'm going to address today is a very different topic, but I hope you will find this interesting, is that how much importance should be, when you are making policies, how much importance should be given to discretion-based policies and how much to rule-based policies when you are making framing policies. In fact, some of the examples with our Mr. Vijay mentioned in terms of giving a nudge telecom push are actually policies which falls in the discretionary category. Now, let me talk a little bit about these rules versus discretion in the policy-making context. Policy-making frameworks across the globe are actually either rule-based, or we call it principle-based, or it could be discretion-based. In a rule-based framework, policy responses always follows a pre-specified plan. So basically, the rule allows the policymakers to pursue the same course of action, whatever is written in the textbook, in all circumstances, or it may direct policymakers to respond to different circumstances in different predetermined ways. But the important point is that the common denominator is that rules are supposed to restrain policymakers' action in advance, because these are most comes from the regular textbooks. However, in a discretionary framework, policymakers have wide latitude to design the best policy response for the given circumstances. There has been proponents of discretionary policy who says that such flexibility in policymaking allows policymakers to respond to unforeseen scenarios, which we are today actually. Separately, such discretion-based policy could be again of two types. And I'll give examples from India, what we are doing. I'll give examples from USA, what they have done, to see which is a better option. But discretion-based policy could actually be constrained discretion and or unconstrained discretion. Constrained discretion could be good, unconstrained discretion could be bad for policy making. Now, let me look into the history of the rule-based and discretionary policy making a little bit. The journey actually started in 1990s. Until the 1990s, you know, must have heard the name of Robert Lucas, who was basically monetary policy expert in the 1970s. His argument was that monetary policy can only impact the variables if the policy changes were unanticipated by the market. So basically, this encouraged obscurity in the market, which we call unconstrained discretion in policy making or openness and clarity. This was in the 1970s. However, in 1980s in US, two group of economists, they were Finn Kydland and Ed Prescott, they argued differently and said that fully transparent rules rather than unconstrained discretionary policy changes, as Robert Lucas actually had said at that point of time, were more efficient and credible. And this was the beginning of the push towards rule-based policy in developed economics, including US, from unconstrained discretion. And that also resulted in greater central bank transparency. Kydland and Prescott, in fact, argued that if you follow a rule-based policy, this will produce outcomes which are consistent over time because they will also make the policymakers' pronouncements credible, as opposed to the unanticipated changes which Robert Lucas propounded. So, however, in 2008, the global financial crisis happened. Again, the course of the discourse of the policy changed permanently, and then we moved over from a system of rule-based policy to a constrained discretionary policy making. See how it has evolved. Unconstrained discretion to rule-based, and again to constrained discretion after the global crisis. Now it was believed that if you have discretion, constraint, it could allow policymakers to respond innovatively to unforeseen problems. Interestingly, in 2003, the former Fed chairman Ben Bernanke had in a speech, he could have anticipated that there was some crisis building up, in fact 4 years, 5 years in advance, when he talked about this constrained discretion. This latitude was particularly valuable in an environment, as was the case post-global financial crisis. And to borrow from behavioral economics, regulator in this scenario was expected to employ their discretion advantageously when there is an opportunity for learning by doing. So that's why you see that all these unconventional policies came into existence from 2008. So if I just sum up for the developing countries, the transition in policy making in developed economies was from unconstrained discretion to rule-based and finally to constrained discretion post the global financial crisis. What is more important? Rule-based or a discretion-based policy, is there economic evidence? There are empirical research which suggests, for example, Gregory Mankiw is a famous macroeconomist who says that constrained discretion-based approach serves the desired purpose if the regulator has credibility. And I'll actually come to that today in the context of the current Indian global slowdown and also the slowdown in the Indian economy. Now let me talk a little bit about the rules versus discretion in the Indian context. In the Indian context, before the opening of the world economy before 1991, there was a lot of unconstrained discretion exercised in the policy making. For example, planning process, it was a means to grow, but there was no accountability in the failure if we did not achieve the planned objectives. And the most important thing is monetary policy was secondary to fiscal policy. We used to do rampant monetization of the fiscal deficit, basically print money whenever we had a deficit. However, with the opening up of the economy in 1991, India actually moved over more to a rule-based regime. However, here again, I have some small points to make. Unfortunately, fiscal policy making in India continues to be dictated by unconstrained discretion. I will give you some examples, despite efforts to move towards constrained discretion. Additionally, India still follows a rule-based policy in specific spheres of monetary policy that could be better served by constrained discretion. We'll come back to this point later. Let me talk a little bit about the unconstrained discretion and fiscal policy in the Indian context. Before 1990s, India used to run a high fiscal deficit, which was 5.8% of GDP on average. And as all of us know, higher fiscal deficit can impact the economy through higher inflation, increased market borrowings, which could crowd out private investment and others. However, the passing of the FRBM bill in 2003, the government made a conscious effort to rein the fiscal deficit of the center and states. FRBM Act was institutionalized to financial discipline, reduce India's fiscal deficit, improve macroeconomic management and overall management of the public funds. And at that point of time, the FRBM Act, the fiscal deficit was reduced to be 3% by 2007-8. And we are firmly on that course. If I remember the prior year, in 2007-8, the fiscal deficit actually was at 2.6%. This had led to a rule-based regimen in policy making. India was moving towards a low fiscal deficit from 2003 to 4 because there was significant revenue buoyancy. However, the international financial crisis prompted the government to deviate from that path, and in FRBM Act was abandoned because we had to give fiscal stimulus to support growth. So we used a constrained discretion, but look how unfortunately this constrained discretion and fiscal policy making too soon has turned into an unconstant discretionary policy making through a flurry of loan waivers, which we have been giving. And of course, there has been some non-transparency in the fiscal deficit numbers. So basically, constant discretion exercise, but we move to unconstant discretion very quickly. Very quickly, if the tax proposals in the current budget, which has been announced, if I give an example of that, this is the example of basically a very useful use of constant discretion turning into unconstant discretion. In fact, the proposals in the budget are noble and possibly an application of the famous nudge theory of encouraging people to make decisions in their broad self-interest and not about penalizing them financially. However, the end research could be just the reverse, because the government is projecting around 80% of the people could shift to the new tax regime. But given the current incentive structure, this number could be much low. It could be even lower than 10%. The only good thing about the nudge theory is that it doesn't eliminate the need for vigorous democratic debates. It has happened in countries like US, Chile, Mexico, Denmark, and Sweden. And I hope that there is enough debate in the next year to say which tax regime we want to go. Here, why I say that this tax policy could be an unconstant discussion, I'll give you I will spare 2 paragraphs on it, on what are the typical determinants of the household savings in India. In fact, if you do a study of the household savings in India, they are a function of macroeconomic as well as qualitative factors. What are the macroeconomic factors? Per capita real income, dependency ratio, inflation, real interest rate, and access to banking. What are the qualitative factors, and that is why I talk that it could be an unconstant discussion, is the incentivization. As all of you know, 3% of Indians have the access to social security. And in a study in 2014, based on a sample of our banks, we found that when this 50,000 increase in PPF was notified in August 2004, the incremental deposit amount had nearly tripled over the August 2014 deposit level for a sample of accounts. And state-wise data at that point shows that Bihar, Uttar Pradesh, West Bengal, each of this population, which is a sizable rural population, they was investing a significant amount in the PPF. And in fact, we also observed that people at the lower quantile of the income distribution were craving to invest more by stretching the number of PPF payments in a year. As all of you know, the minimum PPF payments could be 500. Clearly, the incentive to invest is a crucial factor impacting household savings in India. Now let me get back again to let me turn to the monetary policy. How the monetary policy in India has been a combination of both rule-based and constant discretion. As all of you know, in 2014, India has adopted the inflation targeting, where the target is set at 4% with a tolerance band of plus minus 2%. And in 2016-17, the Reserve Bank of India has constituted a 6-member MPC, which now sets the benchmark interest rate. Interestingly, this inflation targeting actually combines both rules and discretion in monetary policy. It basically uses a constant discretion framework. 2 elements are over here. There is a precise numerical target for inflation of 4%, and second is response to economic shocks in the short term. This emphasis actually allows policy to address objectives such as smoothing outputs over the short term. Let me take an example of the Reserve Bank of Australia over here, which has actually done this policy extremely successfully. In Reserve Bank of Australia, the target is 2.5%. But what they do is that experience in Australia and elsewhere shows that inflation is difficult to maintain within a narrow band. So what the central bank does is that it allows the role of monetary policy in dampening the fluctuations in output over the course of the cycle. So for example, when the demand is weak in the system, inflation is low, monetary policy is eased, which gives a short-term stimulus to economic activity. And exactly the opposite is the case when the aggregate demand in the economy is strong. Following this, so basically there is no emphasis on reaching to the midpoint of the target at a one point of time. Following this method of inflation targeting, since 1990s has resulted in excellent economic performance of Australia. Average inflation in Australia since 1995 is 2.7%, very close to the 2.5% midpoint, with no record of recession in 25 years. Interestingly, the recent announcement by the RBI in the monetary policy of this also known LTR or CRR changes are specific examples of the use of constant discretion in monetary policy making. Because since the central bank is saying that we cannot cut the interest rates below a particular point of time, so why not use of constant discretion? Let me last turn to bank supervision. In India, the RBI has been following a very rule-based policy of prompt corrective action. The PCA framework is employed internationally by regulators as a form of structured early intervention resolution mechanism. In 2002, December 2002, the Reserve Bank of India introduced the PCA framework. It was along the lines of the Federal Deposit Insurance Corporation's PCA framework, and it was respected to the bank financials on March 31st, 2017. But let me mention a point over here. In the US, the PCA framework is based more on constrained discretion rules rather than they are applied contextually. In India, the PCA framework is actually more rule-based, and hence it is a little more on the stringent side. For example, as far as the provisioning is concerned in India, Indian banks are subject to a gradual days-wise provision for the substandard assets, 15% in the first year, 100% in the fourth year, irrespective of whether collateral is available or not. In the US, if I give you an example, provisioning norms are purely discretion-based. For example, in the case of a commercial loan, the fair value of the collateral is taken into consideration to account for provisioning if anything is required. For a mortgage loan, only on 270 days delinquent, all mortgages are placed on non-accrual status only if the value of the collateral is inadequate in servicing the loan value. And in fact, if a mortgage loan is fully insured, is not even placed on non-accrual status even after 90 days. The FDIC triggers the PCA based on bank capital threshold and leverage. In the Indian context, the RBI PCA threshold also include asset quality and profitability. So basically, provisioning rules in India are more rule-based. There is also the case of the Basel III norms. In Basel III norms in India are actually stringent than the international norms, which are norm of 8%, 9% risk-weighted assets against 8% recommended by the Basel Committee. Finally, I'll talk a little bit about the unconstrained discussion of policy in other spheres of policy apart from monetary and fiscal policy. One immediate example of that is that Indian financial system is that the Indian financial system regulatory architecture is complex, number of regulatory, quasi-regulatory, non-regulatory bodies, and because of their overlapping spheres of concern and influences. For example, the Reserve Bank regulates credit products, savings and remittances. The SEBI regulates investment products. IRDA regulates insurance products. PFRDA regulates pension products. So essentially, most regulators turned out to be entity-based. And interestingly, in addition to all the regulatory agencies, certain ministries of the government are also involved in the policy making in the financial system. Public sector banks, for example, is one of them. The state cooperative banks is actually another example where the state government has more role. It's good that it has currently been changed. So in conclusion, what I would like to say, a little bit of experience for India. First, the transition in policy making in developed economies was from unconstrained discretion to rule-based, and finally back to constrained discretion. If I take an example of India, policy making in India has been largely unconstrained discretion in the sphere of fiscal policy and agencies of the government as far as regulating, for example, PSU banks are concerned. Monetary policy, on the other hand, is a combination of constrained discretion and rule-based policies. In fact, India still follows a rule-based policy in specific spheres of monetary policy that maybe, that's a matter of debate and research, maybe served better by constrained discretion. Let me emphasize that the bias towards a rule-based regime in India rather than a discretionary-based policy has a specific purpose. This I would like to mention over here. Why? Because as the saying goes, if you give someone an inch, they will actually take a mile. This is why a rule-based policy regime has also been somehow preferred in the Indian context as far as the monetary policy is concerned. A discretion-based policy can often result in misinterpretation of the rules, as unscrupulous elements can grease the palms of the implementers to get more discretions, and therefore people who follow rules may be indirectly punished for their honesty. If this is the attitude, it could lead to a breakdown of trust in the system and rules. So on this note, let me end this lecture with these wise words by Franklin D. Roosevelt. I just quote from it: rules are not necessarily sacred, principles are. And the core principle is to guide us, should always be the well-being of all our citizens. If this is so, use of constrained discretion in policy making, because use of properly framed principles suited for country can only help us in the long run. I'd like to thank all of you for a patient listening.